Welcome back to Golden Rule Radio. Glad to have you back this week. And without further ado, we're going to jump into the precious metals markets, which haven't seen a whole lot of activity. Miles, you want to just start with gold?
Sure, Tori. Appreciate it. And moving into the end of the year, as expected, gold continues to trade sideways, still sitting in that high 1470, 1480 range, currently about 1475. Looks like it's going to continue stair-stepping up until we see a little bit of topside resistance. So still looking for some higher prices, maybe starting off at around 1490 would be the first potential reversal point down. And then we're back up into the 1500s if it pushes past that. So we still do have a little ways to go on gold, obviously with that high almost 1560 earlier this year, but a heck of a year, guys. So moving up this summer about 30% or closing into it, and then having a very, very tame correction back down. So we've been hoping to see a little bit of lower pricing. I guess that's still a possibility, but do be aware that if we get up into the 1500s, we test those old highs around 1555, 1560. It is possible we could be starting our next leg up sometime next spring.
Yeah, if we paused here and closed the year at 1475, gold would be up right at around 15% from the open January 2nd, obviously, of 2019. So not a bad year. You mentioned the near 30% climb from low to high that occurred this summer and into September, but still 15% finish this year would be welcomed.
Moving over to silver to round out the year, silver is a much prettier chart in my opinion because we did have that deeper correction. Now we haven't come all the way down to the 618 fib, so I actually am going to stick with what I've said over the last couple weeks. I think we have one last push down in silver to give us a nice technical reversal point and then up from there. However, if I'm wrong, that means we're pushing up above about that recent high 1720 that we've seen here over the last couple weeks, and then we'd be looking back up into the 18s before we have any sort of resistance on that level. So silver, again, both ways to go, but we're kind of at that break point, just being about 20 cents below this previous high. We're going to stick with the guns. I think silver is going to top out here over the next week, end of the year, and probably take one more little push down before we see a nice reversal point and a nice entry opportunity for that next leg up in silver, which probably pushes us up into the 23 range, I think is maybe reasonable.
I agree. So because this is our last show of the year as well, just because Christmas and New Year's Day are both the next two recording Wednesdays, I do want to close the year here as if we were closing the markets, all right? And that being said, silver is up 10% on the year. So gold's outperformed silver a little bit. That's why we've seen that ratio increase from around 81 to 82 all the way up to around 86 is where we would close now, 86 to 1 in terms of that gold-silver ratio. So still favoring silver. And Miles, if we do see that pullback that you're alluding to, we could see it climb into the higher 80s, maybe even the low 90s again.
So moving over to platinum as the charts keep getting prettier, platinum did come down to a nice support level, and we saw a 618 fib correction, and lo and behold, it's bounced back up about $25 or so. So while silver, I think, is going to take that next leg down, I know we talked about this last week, I think platinum should be looking at testing that previous high around 950 and possibly breaking it on this move. If that happens, then we're looking at platinum moving into more pricing that we haven't seen in a number of years and starting to play catch up with gold. So we've said for a while gold has led the charge in the beginning stages. It looks like platinum and silver, because they've taken these deeper corrections, they're probably going to turn around faster and more aggressively than they have in the past. So be on the lookout for the white metals to finally start tightening those ratios that we all know is going to happen eventually.
So all that being said, platinum, if again we closed here for the year, would be up about 20%. So outperforming both gold and silver. The only issue there is that it's been outperformed by palladium. If you want to kind of run into the palladium chart here, Miles, and tell us what an exciting week we've had in that metal.
Yeah, palladium, since we're rounding out the metals, up like almost 60% for the year, has had quite the week to close out at least pre-Christmas year, pushing up and just giving 2,000 a kiss. before it did have a pretty aggressive turnaround. However, that's probably just because of the 000, which is one of those psychological levels you'll see people use as resistance, even though there's no technical reason behind it.
Well, big exit points too, right? I mean, you could have sell signals triggered that are computer generated at that point. As soon as it touches
Correct.
it, boom, they're out. That's probably the number a lot of people have been waiting for before they do get out of Palladium.
Right. So we'll see how it responds to 2000, how stacked those orders were at that 2000 mark. Wouldn't be surprised to see a pretty good sell-off if that happens. And if it does, it should be pretty substantial. I mean, we're talking about a pretty massive move in the Palladium price, especially over the last couple months.
Yeah, our numismatist pointed out this week that Palladium is now higher priced than gold has ever been in its history. So who would have thought that at the start of 2019?
So taking one last glimpse at the markets here, other than the precious metals, but what are we also seeing in the equities? And the equities have, despite having that pretty good drop off on the industrial Dow, have rebounded. We have put in a new high, but we are sitting just above this long-term rising trend line at the high. So not a lot of movement in the Dow, not a lot of movement in the markets this holiday season, which is unfortunate to see. But comparing that to the transports, we have actually seen movement, and the movement's been down. We put in a low following Thanksgiving. We've rebounded back up, but it didn't even come close to matching that pre-Thanksgiving high, which was lower than the previous highs. So what we're seeing is a string of lower highs and compression up on the bottom side, higher lows. So eventually we're going to have a breaking point at the transports, and if it breaks down, you would expect to see the industrials follow suit, and that could end up looking real ugly for some retirement accounts, 401ks, things like that earlier in the year. So do pay attention to your equities positions. I know it's really easy to get complacent and comfortable when prices keep going one direction for an extended period of time, but don't think that markets only go one direction. The only way you make money in markets is by understanding how they cycle and getting on the right side of it.
Yeah, it does appear that it's shaping up to be a disappointing holiday shopping season again for the second year in a row. So we'll see what sort of impact that has in the equities markets as numbers and earnings come in that first half of January. And to me, I do expect from what I'm reading now, it's going to be a little disappointing. I'll tell you what does work, though, is the injection of capital into the systems through the central banks. And I think that that's what they have found, to be effective, at least for a short period of time. And, even though 2019 has seen an all-time record central bank gold buying level, breaking the previous high set in 2018, that Fed easing is the other tool that they're doing. I mean, they know that something's going on, but what we see in the form of, potentially this QE4 is going to boost the stock markets again. The late, great Larry Edelson did call for 30,000 on the Dow Industrials before we saw the major pullback or major correction. And, certainly at this level, that's not a huge percentage gain. We could get there relatively quickly. But look at this chart on the Fed easing and how it boosts stock prices over the years, really just starting from back in 2008 at the time of the crisis when they really came out with that quantitative easing. And you'll see that as they go to continue and ramp it back up, it should have that same effect. But now we've got new news that the Fed's going to inject a total of just shy of $500 billion in the next 30 days in the repo market. That, to me, is a panic. That's an unprecedented panic. And there's a great Zero Hedge article here that we'll give you the link to. And that comes just a couple days ago where they unveiled this historic liquidity injection. And that, to me, is mind-blowing. And it's a proactive fire hose of liquidity per the article. It's not a reactive, like the QE 1, 2, and 3 were.
Sure. So if you thought that 225 a few months ago was big, we're more than doubling it.
Yeah, all central banks are getting desperate here. We don't know really what they're hiding or what they're afraid of. China is taking measures as well. You do have huge dollar defaults going on in China. There's a company, Taiwu, that's, now the largest or a record dollar default or restructuring that we've seen, and that's coming out of, we already know, a weakening economy that is slowing in its growth. And here domestically, though, on the gold price, as you are alluding to, Miles, not a whole lot of movement here the last couple of weeks, despite so much political uncertainty. The impeachment hearings proceeding really don't appear to be roiling the markets at all, moving them one way or the other.
Or if they are, they're stagnating the growth that we're seeing in the markets, as it has been up, but only just barely. So one of two things is happening, right? Either there is some response and the rampant liquidity that's coming into the market from the Fed is what is causing the push up that we are seeing, or coupled with, I should say, because we know that is actually the case. So coupled with the fact that we have this impeachment trial, which is adding some uncertainty to the markets. It's holiday season, which should be positive, but isn't. I mean, the memes are flying around Instagram and Twitter right now about, frankly, people's inability to afford the gifts and the vacations and the things that they would like to. So in the on paper healthiest market we've ever been, as long as you don't pay attention to things like inflation rates and money printing and repo markets and everything else, what's going on at the White House, as long as you ignore the man behind the curtain.
Or your own household budget.
And just focus on the Fed budget, which has that magic printer button, then everything should be fine. So with the Trump impeachment followed by an election, there's going to be some tumultuous issues both here domestically, as well as let's not forget that this repo crisis is an international crisis being funded by our federal government.
I agree.
Let's not forget that point.
No.
We're not just bailing out U.S. banks in this market. We're bailing out Deutsche Bank. We're bailing out other European entities. This is an international problem that we have shouldered the bill for, and that's your tax dollars.
Yeah, and you still have to settle out Brexit in 2020. I know we keep kicking that can down the road a little bit, but Boris Johnson is trying to negotiate a trade deal, and we'll see how that plays out. But you talked about ignoring the inflation rates. You're exactly right. Here's one more chart for you to ponder, and this is from John Williams, who does a great job with shadow stats. This is his 1980-based alternate consumer inflation chart, and it really does show that you'll see here we're more accurately at around a 9% annual inflation rate. So when you're putting all this money into the system, which, by the way, is going to cause the Federal Reserve to exceed its all-time high of a $4.5 trillion balance sheet, when that happens, you naturally are going to get inflation. Okay, it just depends on how it's reported. So they may report 2 to 2.3%. We know in reality it's closer to 10%. And all that money guarantees that gold will go up over time. There's just too much of it to account for.
So with that, we just want to say a Merry Christmas and Happy New Year from Golden Rule Radio in order to let you enjoy the next couple weeks without listening to us discuss some of the problems in the market. We think that time's better spent with our families and your families. So we are done for the year, and we thank you for spending 2019 with us. Look forward to picking back up in January of next year, and in the meantime, again, we hope you have a wonderful and blessed holiday season. This has been Tori and Miles with Golden Rule Radio, your weekly recap of the precious metals market. You can find us on Twitter at ICA Gold, Facebook, McIlvaney Financial, or our website, McIlvaney.com. And as always, if you want to give us a buzz to discuss your personal portfolio, we can be reached at 1-800-525-9556.
Thanks for listening. Happy New Year.